So I thought about that a little bit, and to me, sort of an alternate title might be stress and opportunity. So I'll start with a couple of hypothetical or not stories that I've seen in the last couple of years to sort of try and help set the stage for some of the material our panelists will get into. So the first story, think of an asset manager, August 2008, so similar to Stephen Galbraith's story from yesterday, sitting on a fund, probably $1 billion in capital. They're looking at 20% returns for the year up to August 2008. It's all looking pretty good. People are happy. They're looking forward to their bonuses. They'll get paid in January. And then certain things start to unravel in the market. And in September, to get the dates right, September 17, Lehman no longer exists. Lehman was a counterparty providing prime brokerage for this hedge fund. Fortunately, there was a good risk management function at this asset manager, so they had multiple prime brokers facilitating the hedge fund, so it wasn't a death nail to the fund. But those positions you had with Lehman are frozen. You can't do anything. The capital's in escrow. It's all locked up. But you have some other prime brokers to deal with. That's a little bit of stress. Some funding liquidity on that fund. But then the hypothetical asset manager steps back and thinks about, well, what can I do in response to this? They have capital, so they have institutional investors that trust the asset manager. Yes, there are some redemptions, but there's no need to drop a gate, so it's not all the money is not running out the door. But it's an opportunity for an investor in that market environment that has capital on hand. And this hypothetical manager sort of thought, well, what sort of things could we do? Or could they do? You think, well, what type of fund is most hit by this funding liquidity crisis? Well, it's going to be the highly levered, and this is in the equity space, highly levered equity long-short funds that are trading primarily on relatively high-frequency trading strategies. So you can think of stat arb as a term that's thrown around, and you think, well, what the hell does that mean? And it's value investing. Prices go up over a short window, and you can't detect any news that would support that price to have risen. Well, that means price is above intrinsic value. You bet that the price will come down. Price goes down, you don't see any news, no fundamental information's gone to the market to justify that. Well, you go long, price is going to go up. So hypothetical asset manager says, aha, there's a lot less capital chasing this type of idea. So whatever risk budget this hypothetical asset manager had, some of it was allocated towards stat arb, some was to other longer term horizon strategies, push a lot of it into this shorter stuff. And hypothetical asset manager does this in 2009. For such a manager, you would have returned 40% plus, like a realized Sharpe ratio of over 5. It's a phenomenal opportunity that comes out of a severe time of funding liquidity crisis. That's story one. So some stress and some opportunity. Story two is just stress. Okay, so again, same hypothetical asset manager, same fund. In early October, they've pre-booked trips to Scandinavia, so Norway, Sweden, Denmark. And they're going to look at their big clients. And this trip was planned in June or July. So if travel's paid for, you're sort of looking at yourself in October, does this hypothetical asset manager want to make the trip? You really don't want to, but they go to meet the clients. And it's a very depressing set of conversations with these big clients. Then the hypothetical asset manager comes back to a big city, maybe New York, maybe London, and they're tired and they're walking down the street and they figure, oh, I need to get some cash. I want to get some hamburger and chips for dinner. So the hypothetical asset manager's trying to withdraw cash from the ATM, and there's no cash. And this is a Friday, I think it's October 7th. No ATM in the first cash, or no cash in the first ATM machine. Keep walking down the entire street, there's no cash in any ATM machine. So maybe Professor Columbus can speak to the existence or not of a bank run, but an incident like that causes significant amount of stress on individuals. Okay, so a couple of stories. More seriously though, this session is, I think, about very, very fundamental primitives that people tend not to think about very often. Now, they've been thought about a lot in the last couple of years, but if you went back 4 years and asked for a panel discussion on liquidity and capital, people are like, why are you worried about this? It's taken for granted. But we've had a very rude awakening to appreciate the fundamental importance of this stuff. And it's liquidity and capital. They are linked. I think of liquidity as the more fundamental primitive here. It's your ability to get your hands on cash. And I'd be interested to see if people can describe actually what cash is. It's your ability to move these stocks of capital around. Okay, and that's a cheeky little slide. So it says an academic review. So I don't think at all is this an academic concept. This is fundamental to the existence of our markets. Okay, so what is liquidity? So I typed into Google and sort of asked Google to tell me. I was hoping to get a nice little definition to put up here, and I was woefully disappointed that about 100 definitions popped up, and they're all over the place. So I thought this is going to be pretty hard to narrow our discussion down in an hour or so. So I made an attempt at it and got some feedback from our panelists. So this is hopefully where the discussion is going to go for the next hour or so. Thinking of liquidity at a macro level. So think of systemic liquidity risk. Obviously, banks are going to be fundamental to this, but they're issues that arise related to liquidity that are external to the firm itself. Okay, you can think of repo markets freezing up, commercial paper drying up, bank runs, those sort of things. And Charlie's going to speak to that and other things. There's the more micro aspect of things. So within a firm, how would you think that liquidity might be important? And it's sort of here, it's the firm's ability to access capital, raise some financing to do the things they want to do. Operating, investing decisions. Maybe it's rolling over existing debt. Commercial paper would be a good example. So Marilla's going to talk about that. And really the financial crisis is a very neat, in a way, natural experiment to tease out or test a lot of theories related to sort of financing activities and operating and investing activities at the firm level. And then sort of separate from that is trading. So you have the financial markets themselves. So there's assets that change hands. And liquidity is paramount in these markets. And so Mark sent me this definition out of the Ammerhood and Mendelsohn paper. So a company's securities are liquid to the extent that they can be traded quickly and at low cost. Okay, I think everyone would accept that. I think Steve Galbraith yesterday mentioned that they have, like, the median ADV of their positions was 1.5 days. And based on what I've seen, that's a very liquid portfolio, very, very liquid. I've seen portfolios that could have 30, 40, 50 days ADV in them. So if you need to sell something and the position that you hold will take you 50 days to get out of, that's a severe risk for that portfolio. Okay, so and Mark and Florin are going to talk about liquidity in the context of capital markets. Mark on the equity markets and Florin on the credit markets. I thought I'd lay out a couple of questions that I'd like to get some answers to. On the macro and systemic side of things, how transparent should interbank lending be? I don't have an answer to it. I mean, some transparency would be good. What are the sources of contagion? What are the linkages between these institutions that give rise to these systemic risks? And then, this might be an unfair question, what's your greatest fear as a regulator? And then, what might your response be to mitigate that fear? On the micro level, so how much cash, there's been a huge literature in corporate finance on sort of excess cash or suboptimal levels of leverage. So how have views changed in response to what we've seen in the last couple of years on some of these basic tenets of corporate finance? And then on trading, this is, I think, where the accounting information can be more central to things, your ability to measure some of these things, and sort of can the financial reporting system facilitate improved liquidity in these markets? And then sort of a more philosophical question, like when the hypothetical asset manager can't get cash out of an ATM, you start to wonder, what the hell is cash? I could never answer that one. And lastly, it's all about liquidity. This is a more personal. So we had the macro, the micro, the trading. Now, at a personal level, I really would like some help here on liquidity, capital, funding considerations for this little thing. Yeah, so it's a house in London. I think Bob Hertz used to live in this one. Yeah. Cool. Well, we're looking forward to our panel discussion. So Professor Colomaris on macro.
Thanks very much, Scott. It's a pleasure to be here. Actually, I'm going to touch on a lot of the issues that Scott raised, and he was kind to send those out. But the first point I guess I want to make is that what we've just lived through, which felt very macro in the banking system, was actually, it's very helpful to think of it from a micro standpoint. So the first thing I want to do is point out that from a cross-sectional standpoint, looking at the banks, this was not a common crisis experience. Ask Credit Suisse and UBS. Did they have a common experience? They're both Swiss banks. They're very similar in a lot of ways. They had a hugely different experience. Credit Suisse did much, much better. UBS was a catastrophe. You could make the same comparison between Citibank and JP Morgan. You could make the same comparison between on the good side, Goldman Sachs, and on the bad side, Lehman or Bear. So yes, there were aggregate consequences to this crisis, but there's a lot of interesting cross-sectional difference. So these are sort of what I would call the troubled institutions. I want to draw your attention particularly to, let's see if this works, yes. This dark green line, that's Citibank, and you can see the market value of equity relative to the market value of assets for Citibank in 2006 was about 13%, and it falls down here to about 2%, just to give you that sense. Pretty high initial capital ratio compared to recent historical phenomena. Here's JP Morgan. JP Morgan starting at about a little under 12%, but of course stays above 5%. Very different kind of shock. So by the way, first thing to note here is it isn't all about capital, 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 as Tim Geithner says. It's about risk, risk, risk. Because higher capital is important relative to risk. Citibank had very high capital. Nothing that Basel is contemplating right now would be particularly problematic for the capital that Citibank had prior to the crisis. Yet, that wasn't good enough. The other thing I'd like you to notice is that there was a huge amount of time. This was actually a slower moving train wreck than you might have thought. Individual institutions, by the way, raised globally about $450 billion worth of capital during this crisis from September of 2007 to September of 2008. But the ones that needed it the most, even though their stock prices were quite positive during the summer, let's say, of 2008, the ones that needed it the most chose not to raise enough. This was not an overnight shock. This was a slow-moving train wreck in which equity values were declining over a long period of time, and people decided not to replace equity that they'd lost. Why? Well, I met with a vice chairman of a company that shall remain nameless in the summer of 2008 over breakfast. I said, why aren't you raising more equity? And he said, we don't like the stock price at which people want to buy that equity and the dilution consequences of that. So if you want to know what's the picture in my mind of the too big to fail problem, it's that fellow over breakfast. Because he didn't want to dilute, and from where he was sitting, the best thing to do was not to. So those are some quick perspectives. Now here's one that, if you don't know this study, I bet some of you will find this interesting. The best predictor we have for this cross-sectional variation is a variable called, and this is, the left-hand side variable here is implied volatility. That's before the crisis. I could put on the left-hand side, instead of implied volatility, I could put ex post loss. I'd get the same relationship, even a little stronger. But there is a predictable variation ex ante prior to the crisis in implied volatility. What's the only variable that's been identified that robustly predicts that variation? It's this thing called CRO centrality. Guess what it is? It's the ratio of the compensation to the chief risk officer relative to the compensation to the chief executive officer. So in companies where risk management was valued culturally as proxied by the compensation to the risk officer, risk management contained the risk level both prior to the crisis and the losses that resulted from the crisis. So it wasn't a coincidence that at Goldman Sachs and Deutsche Bank, places that are famous for their valuation of risk management, that they managed to avoid the worst shocks of this crisis. So before we start talking about liquidity and capital, I just want to emphasize here are some things that I think when I'm designing regulatory fixes, and I've got a long list of them actually in a recent paper that I just wrote. Inaccurate measurement of risk ex ante is key, not just capital, 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 but risk, risk, risk. Secondly, timely ex post recognition of loss. These banks had a lot of time when the market was saying that they were experiencing losses that they didn't raise adequate capital when they could have because they didn't want to be diluted. And that's related to the moral hazard of too big to fail, I would say. And we also want to ask, when we're designing fixes, we really want to focus, therefore, on incentive problems in ex ante risk management and in how you respond to loss. I want to emphasize two different timings here. One is ex ante before shocks hit, and secondly, how you respond to the shocks in terms of raising capital to replace lost capital and managing your risk after you've had some loss. And that's going to very much inform my discussion here of liquidity versus capital. If you don't think that way, you're not going to find a reason to have liquidity as opposed to just capital. I want to say it again. Recognition of loss and replacement of lost capital is, we want to create incentives for that. And we also want to create incentives to measure risk prior to any shocks in the first place. So the models that are going to deliver for us in banking, because I've got some of them to tell you about, the models that are going to deliver for us are going to have to be precisely focusing on those incentives. Recognition of loss, replacement of lost capital, and in the first place, managing risk properly. So I'll advertise for the paper I'm not going to talk about, which is a longer paper with a longer agenda. But what I want to focus on today is just the question at hand. What's the role of liquidity from the perspective of those lessons? And why do we need it in combination with capital? You might think this is kind of just silly that we're even talking about. Of course we need liquidity. And by the way, I think so too. And I'll point out to you that prior to the last 30 years, the primary focus of prudential regulation was on liquidity. But that's not been the focus of the last 30 years. It's shifted to capital. That's quite strange and interesting. But by the way, when I talk about this topic with a lot of my colleagues, they don't think that there really is a need for liquidity on top of capital. Some of the best theoretical economists working on this issue don't think there is. Why? Well, because they come at this topic, first of all, from basically what I would call the Merton framework or the Black-Scholes-Merton model. And if you come at things from that standpoint, I'm going to show you a quick version of this. This is what risk-based capital means in finance theory, in frictionless finance theory. What we want to do is we want to target a default risk for deposits of the bank. So that's the top diagram here is a 1 basis point default risk, meaning that the actuarially fair compensation to the depositor is 1 basis point over the riskless rate. And to do that, I've got, this is just a graphical representation of the Merton model. I have the equity to asset ratio here, and I have the risk of assets, standard deviation of asset returns here. And you can see that this is what risk-based capital means. Hold an amount of capital commensurate with risk. And if you, as long as you stay on this line, you're targeting a 1 basis point default risk premium. That's what risk-based capital, this is how we should be talking about it in Basel. We don't. But finance professors know better. They know that this is how to talk about it. So you can see that we have two tools. We can either require, if we want to target this, we can either say, well, if your risk is here, make sure your capital's there. Or if your capital is down here, then you're going to have to make sure your risk is here. How do I do that? Hold a lot more cash assets. So what cash means to finance theory, frictionless finance theory, is just something that lowers the riskiness of assets. And so you don't need a cash in this. All you need is to tell banks that their combination, that we could target capital based on risk, and we'll achieve this. Why do we need liquidity per se? Why do we need to constrain the riskiness of assets in some sense? What we really want to do is just target a 1 basis point default risk premium. So that's really where this conversation, I think, begins. It begins from a kind of neutrality proposition that says you really don't need cash. Now, more realistic models, though, say that you do. Murillo's going to talk a lot about this first category of models. And the basic point of this category of models, and I'll leave him to go through the details, I'm sure he's going to, is that debt capacity and cash are imperfect substitutes. Especially during crisis times, debt capacity disappears, and cash, therefore, has huge real option value for dealing with liquidity needs during crises. That doesn't happen in the Black-Scholes model. That debt capacity that I graphed before is constant. But if you think that there's a sort of stochastic shock called a crisis where debt capacity disappears, cash has real option value. And that's especially true if you're an entity called a bank or a shadow bank, where you're doing this huge liquidity transformation, which means that your debt rolls over constantly, and you can get stuck with this funding liquidity problem, meaning you've got to fund yourself overnight. And if you don't remember anything else I say to you, here's another thing that finance theory hasn't figured out yet. Money market debt instruments are risk intolerant. They're not risk averse. They don't just price risk, they run from risk. Asset-backed commercial paper, repo, LIBOR, deposits are not interested in just repricing risk. They have a limit of the amount of risk they will accept. When the risk exceeds that, they don't roll over. That's what a bank run is. That's what an asset-backed commercial paper run is. And there is a banking theory there are some banking theories, and I worked on them 20 years ago, that explain that. But that is fundamental to understanding where funding illiquidity comes from, is understanding why money market instruments are risk intolerant, not just risk averse. Now, that's only one theory. Murillo's going to, I'm sure, talk about that a lot. I want to talk about some other theories. I have a paper right now on this theory. But this is not a very hard theory to understand. It starts with the following proposition. We know that we can mitigate risk of default on a deposit either with more cash on the asset side or more capital on the liability side. What's the difference? Big difference number one, putting aside the real option theory for a minute. Big difference number one. If a banker says that he hasn't lost money on a loan that he's lost money on, and if the supervisor forbears and lies with him and says, no, that hasn't suffered any loss, no accountability. There's no problem. And they do it routinely, over and over again in every country, in all of the 100 major banking crises of the last 30 years, if you missed them, by the way. That's called lying. The polite word is forbearance. Here's the difference. If you lie about the amount of cash assets on your balance sheet, you, the banker, and the regulator will both go to jail. That's a very essential difference between cash and capital for regulatory purposes. Capital is a lie agreed between the banker and the supervisor. Cash is real. And cash has, because it's real, when a shock hits, cash also has different incentive properties because capital, when the shock hits, is overstated. Cash isn't. And there's another important incentive property of cash. It's riskless. So incentives to what we call in finance asset substitute, conditional on loss, that is to increase risk after you've experienced a loss, are much less if a substantial portion of your assets is riskless because you don't get the upside gain of increasing the put option value on your debt. That is, it limits the advantage to you of asset substituting. So that's the point of the second story. And there's some other stories that are pretty interesting too. But I'm not going to go into them because I don't think they're as important. One that's very important in a case I'm going to talk about, a very successful case, the Brazilian resolution of the financial crisis, is that it takes the pressure off the lender of last resort. Now, we've seen our Federal Reserve become more politicized than it's ever been. We can, I think, all agree it would have been better if the Fed hadn't had to do as much lender of last resort assistance as it did. Well, the Brazilians didn't do any. They didn't do any lending, the central bank in Brazil, during this crisis. And the reason is because Brazilian banks have 20% of their deposits in liquidity, in reserves. So that was another huge benefit of having cash. It takes pressure off of the lender of last resort. Okay, so I now have a bunch of slides that I'm going to skip because what they're all about is showing to you that funding illiquidity of the banks was a big problem that led to market illiquidity when they had forced selling of a lot of assets, huge opening up of spreads in risky debt, and also sales of equity, and also huge contraction of credit supply. So I'm going to argue that this funding illiquidity problem was actually very important during the crisis, but I'm not going to show you that evidence. I'm going to skip it. What I do want to show you, though, is that people understood this in the 1850s in the US. The New York clearinghouse's prudential regulation was a 25% cash asset ratio requirement, not a capital requirement. They had no capital requirements. But to avoid free riding and mutual protection among clearinghouse banks that made markets in each other's deposits during crises, to avoid free riding, their regulation was a 25% liquid asset ratio. And I would suggest that they talked about it very much in the way that I'm thinking about it and describing it to you today. And if you haven't read the famous George Coe, who was the president of the clearinghouse, 1873 description of this, I recommend it to you. It doesn't work perfectly because the banks aren't always willing to lend out their reserves to each other. And by the way, that's why we need a lender of last resort. And there's some interesting history there, too. I'm going to skip all of this discussion. Some pretty interesting evidence on liquidity. You can get my slides if you want. And what I want to do now is, so is it worth trying to fix this problem? If you're not aware of it, for the 100 banking crises we've had worldwide for the last 30 years, the average cost has two components. Cost can be described in two ways. One is, what's the effect, what are the sizes of the recessions that accompany those banking collapses? About 16% lost GDP. I'm sorry, 20% lost GDP. How about the bailout costs of the negative net worth of failed banks? About 16% of GDP on average. So we have had, this last crisis is not an isolated event. This last crisis is part of a pattern of the last 30 years worldwide that has looked nothing like what our experience was historically. So there's something about the combination of government protection of liabilities without effective prudential regulation that's creating this disaster that's happening over and over again. To show you how banks in New York City dealt with the Great Depression, by the way, none of the major banks in New York City failed. What they did from the standpoint of that Merton model I showed you before is that basically in the 20s they increased risk and capital dramatically. And then when the Great Depression hit, they lost capital and risk increased. But then they cut back their lending, increased their cash, and went back to a point like Z. Here's what it looked like from the standpoint of their balance sheets. Their cash assets started off being about a third, dropped to about a quarter of their assets. This is the ratio of loans to cash assets. But by the end of the period, the cash assets were about 3/4 of the balance sheet. That's called a credit crunch. But it's also called no banks failing. And you could see that they were targeting the p-value of their debt, starting off before the crisis at 0 basis points. As the shock hits, rising to pretty high, but then coming back. So market discipline was the thing that kept banks from failing, both in terms of ex-ante risk and how they responded to the crisis. They scrambled for liquidity, and they had a lot of liquidity even to begin with. Brazil, as I said, is a pretty good example. They have a very high required reserve requirement. They cut it dramatically to allow banks to have liquidity to respond to it. And that real option value was very useful to the Brazilians. And as I said, they never even had to have a loan from the central bank, although that needs to be understood. They also twisted some arms to avoid, among the banks, to avoid having to make those loans. Yeah, I know, we're done, right? This is my closing comment. I'm going to leave this up here. We have very convincing arguments about the need for a liquidity requirement along the lines of what I've said, but we do not have a convincing model of the size of that requirement, because every model I've just told you about is what I call a toy model, meaning that it illustrates a point, but it doesn't have the quantification and precision of the Merton model, right? So we're kind of stuck. And my answer is use history, use cross-country experiences about what has worked in the past to guide us, which is why I advocate about a 20% of assets liquidity requirement. That's it. Thanks.
Okay. Charlie, thanks very much. Next speaker, Murilo Campello, on the micro aspect of liquidity and capital.
See if I got this right. Okay, so thanks for the invitation to come and discuss these issues on microeconomics, but it's mostly about corporate finance. The issues I'll be providing, just overviewing here what's been done in research in terms of liquidity, corporate finance, financial management, risk, and of course we cannot skip the financial crisis. That's going to permeate most of my comments here. Now, we learned a lot about management of liquidity at firms with the financial crisis. But it's not that we didn't know anything about it before. So there's ongoing research on this topic. It's a big topic of research in corporate finance. I'm heavily involved in this. I would say that most empiricists would agree on the fact that if you look at firms' cash holding behaviors and what they do with liquidity, and liquidities up until this point was thought of as cash, only cash, and no other options on liquidity, which I'll be talking about soon. The crisis taught us about that as well. But we had a long string of research in this area, and many questions were asked the data, and the data, we think, told us that although people out there might think firms hold too much cash, that's kind of a something that is an appealing factoid. You think firms seem to hold too much cash. There's no reason why they should be holding that much cash. You can always think of Microsoft, which is a counterexample to anything we know in corporate finance. But if you ask managers, what is it that why is it that you hold cash? They would say, well, we don't hold cash just for the sake of holding cash. We do it because capital markets are imperfect. We do it because we have to. We may have this, and I'm talking big companies, pharmaceutical companies is a good example. Big ones, they say, well, we may have a great idea, positive NPV project, you name it, we can quantify it in any way. You bring it to the capital markets, be it a banker, be it the bonds market, you name it, and they'll say, well, I can't really see what you're telling me. I don't really believe what you're saying, or I'm not comfortable with you, the company management, or I like this idea, it's all fantastic, but boy, I need collateral, and you don't have it. And for those reasons, firms would say, well, we need to save cash. So I have myself written some work in this area, and it's substantiated with data, these priors, and some of the main factors you want to take home from research in corporate finance and liquidity is that if you compare firms' cash holdings, you typically look into firms that are financially constrained, as we call it. Those are firms that report difficulties in finding funding, fairly priced funding for their capital ideas. You find that they hold way more cash than other firms that tend to not report so many difficulties in raising capital. And so we do it with data, and we break up samples of firms, public firms out there, and we look into things such as small firms versus big firms, or firms that pay dividends versus firms that don't pay dividends. And we systematically find that those that are financially constrained, have a hard time borrowing, are the ones that are having to hold more cash. So, the capital markets imperfections are putting a burden on firms. They have to carry around that access, easy access to liquidity, and they do it internally. They just save cash. Another way to look into, we can literally look into the cash holdings of firms, and we find this. Another way to look into, into this, have an insight into this behavior is to look into how firms save cash out of cash flows. So firms make money, and you take to look into their savings behavior. You'd find that in that dimension too, you really literally can just simply run a regression on firms' cash savings behavior on their cash flows, and you find that firms that are financially constrained, say small firms, to make it, give you a more concrete example, is small firms save more cash out of their cash flows because they have to. That's the way they can finance profitable investment. So the point is that we knew a few things about corporate savings, why they are as high as they seem to be, what determines their behavior of actually saving cash and spending cash with investments. We also knew, coming to the crisis, looking at the macro picture of firms, we've noticed that they have been saving a lot of money, a lot of cash. They're building up reserves over the last 30 years. And we're thinking maybe there's too much cash in firms. There's some new studies showing, though, that if you break down firms by the kind of risks that those firms face, and this is measured by cash flow volatility here, you actually will find that firms which are saving more cash are the firms that are more have riskier cash flows and have a hard time finding financing for that kind of investment. Now, this is actually a picture of cash savings behavior over the last 30 years, the simple ratio of cash over assets. And the line in the top are literally the firms which are the riskier firms in the economy, the riskiest firms. And then you have, as a measure of riskiness declines, you have less saving over time. And you're thinking, okay, that's interesting, but what does it tell us in the macro picture? Well, what you're seeing is that most firms in this economy are becoming service-oriented. That's what the U.S. economy is becoming, coming from the 70s to the 2000s. And firms in our time they have less collateral to offer. They have less. They come to the market very, very early on, and they don't have the track record that the other firms used to be in the past. So there's a push to actually having more cash in the bank. Now, let me go quickly to the crisis, though. We learned that crisis can happen. Liquidity may fail. Firms may have even tougher times facing the market. And Lehman-type events do happen. And what do you do? So not surprisingly, we found out, research has found out that firms that have more cash coming into the crisis are the ones that did better. So here this research has broke down the firms that you can find out their data for in CompuStat. That's a usual data set that we use. And if you rank firms by the level of cash they had coming into the recession, perhaps not surprising, you're going to find that firms that had low cash had to cut investment way more than firms that had more cash. So the firms with high cash reserves did not cut investment at all, whereas firms with low cash reserves were forced to cut a lot of cash. Now, this is all interesting, but wouldn't say that's okay, but firms had so much cash coming to the crisis. We know this. The point, though, is that cash, firms eventually run out of cash. And they're scrambling to see, get liquidity from other sources. And in the picture of research, entered this new element, this new instrument that we never cared about before, which are lines of credit. So it turns out that lines of credit were the new source of cash for firms for the second half of the crisis, so to speak. And it's interesting because the old belief we had in research about lines of credit is that they were essentially unreliable. They only helped the firms that did not need them, firms with high cash flow, high profitability, easy access to credit. But it turns out that it did play a big role in this recession. Taking a step back, we were surprised, coming from the macro literature that Charlie talked about before. We were quite surprised during the recession when people find out that loans actually increased during recession. So if you look into the Federal Reserve accounts, you'd find that the recession is right here, easy to see. You see an increase in deposits and loans in the toughest times, and people were thinking the banking system is working. But if you look carefully at what was going on there was no fresh lending. It was all LCs being drawing down resources, firms drawing down resources from lines of credit, which was quite surprising. And then, so the questions that we were asking are, thank you. There's some research that I've done myself with Duke colleagues. We actually asked 1,000 CFOs in 40 countries about this trade-off between cash and lines of credit, trying to understand how they're managing liquidity. And we asked this in January 2009, the worst of the times. And to summarize our research in two little graphs, the U.S. CFO said that those firms that are financially constrained, they said that between 2008 and 2009, their cash reserves went down by 25%, were totally depleted. Whereas if you look into their lines of credit, they were intact. They did not change at all. So they really turned into lines of credit as the recession worsened. Then the questions that you ask, say, okay, lines of credit were available, but did firms really use them? And as they use it, did the prices change? What did they do with the money? And so this is the new wave of research that people are doing, publishing papers in this and asking those questions. I have a couple of papers where we keep interviewing CFOs in U.S. and Europe, and we do find out that the amount of lines of credit, the proportion of lines of credit as a function of the whole external financing of firms was quite high during the recession. Was very, very high. And we like to break out between size amongst firms across different sizes, or whether public or private. And you find out that lines of credit became the lifeline of many firms out there, but especially those, as you'd imagine, that are smaller, that are private, and have no bond ratings. So just a couple of more slides. Let's get this right here. Okay. So these are prices going up a lot in terms of markup spreads on lines of credit. Clearly, they went up in the crisis. This is 2008 spreads, 2009. They did go up by a lot, but they were still available. Maturity shortened as well. So a big question then is like, okay, that's interesting. So firms have this new tool. There's a new tool for a new point of research for interest for research as well, which is this other source of liquidity. The big challenge is, what is liquidity and how does it work in the crisis? There is cash ran out. There's this other thing called lines of credit. How important it is, it was totally under the radar screen of research up until the crisis. And then the questions start asking is that firms use those funds to do things that matter, such as hiring and employing people and doing R&D research. And I have here a graph that it kind of tells us what's going on. In one graph, kind of try to summarize the whole picture. So this graph tells us about the propensity of firms to invest their cash flows in real investment, name it employment or capital, fixed capital, as a function of the level of the access of lines of credit that they have. And basically, what this graph says here is that when you have very little LCs, very little access to lines of credit, the cash flows that you make, you do not invest. You basically save them. As the access to lines of credit go up, and that's the second segment of the same line there, well, then you start saving, then you start investing, then you start doing good things with your cash. So lines of credit do work in tandem with liquidity cash flow to make important investment decisions. And that, too, was something new. People thought lines of credit were just an insurance policy that you buy and you leave on the side. You never use it. You don't touch. You're not supposed to touch it. But in the crisis, they were key to actually firms' growth after the crisis. And we're talking again about real investment decisions, not just switching cash and how you call cash, but it's really disbursement into real things. Okay, so just to kind of finish up, and just my last slide here, and kind of in a way look back to the macro picture a little bit. There were also some pervasive effects of lines of credit. Lines of credit had an interesting feedback into the banking sector. And the reason being is that if you ask CFOs about lines of credit, they'll say, well, we draw down those lines for good reasons. Okay? So this is 50% of constrained firms did use those the access to lines of credit to do liquidity management. But if you ask them about, did you draw down those lines of credit just for fear of being denied it later, or for fear that your bank will run out of cash or funds, you'd find that among constrained firms, the riskier firms, about 17% of them draw down cash just for the sake of drawing down cash, just so they would not suffer if their banks run into trouble. Now, clearly, the problem with that is that if firms start doing this for the sake of doing this, then banks do get into trouble. That's the whole, one of the main reasons why you have failures such as CIT Group was that firms did draw down the lines of credit. CIT used to lend to firms on the margin of the economy, smaller firms, and those were the first to draw down the lines of credit. And you have CIT filing for bankruptcy in late 2009, allegedly, for an excessive run to their lines of credit. So the interesting thing is that then you have a feedback effect into the financial markets, into the financial system, with financial institutions suffering as a consequence of the way firms start managing their liquidity during a crisis. Okay, thank you.
Okay, Bruno, thanks very much for that. We're going to switch now back to the trading or capital markets perspective, first with Mark Lang. I want to make one little quick comment. I'm very impressed that Murillo was able to get any CFO to respond to a survey in Q1 of 2009. That's truly impressive.
We're negotiating. So I had lost 5 minutes, now I've gotten 2 minutes back. So we'll see how it goes here. I think it took me 14 minutes, so this will maybe be about 12 minutes here. So thanks for the opportunity to come out. It's been a fascinating conference so far, and hopefully I won't change that. This is work with Mark Maffett, and Mark is PhD student extraordinaire. So if you're on the market next year, Mark will be out there, and you'll definitely want to have a look at him. I also mention that just because when I say we, it's not the royal we, it's Mark and I. And we're interested in the relation between transparency and liquidity uncertainty, and in particular, we're interested in crisis periods here. And so what I want to do is spend just a little bit of time talking about sort of the theoretical underpinnings or the papers that got us thinking about the direction here, because for me that was the most interesting part of it. And then to the extent that I have to skip a few slides, it'll be some of our regressions at the end. But I think once you understand sort of the story, the rest of it follows in a fairly straightforward manner. So why this question? Well, Mark and I were working with Carl Linz in finance on a question about transparency and liquidity in general. And we noticed that we were getting lots of invitations to present it, in many cases unsolicited, and we realized that the reason for that was because with the financial crisis, lots of people believed that it had something to do with liquidity and it had something to do with transparency. But our paper really didn't address that issue because, as with most of the research literature, the question we were interested in was sort of what determines the level of liquidity. Right? And if you think about what happened in the crisis, it was not that liquidity was low and it had always been low. It was that liquidity changed dramatically. And there seemed to be an impression that it changed especially for opaque classes of assets. And so that's what we decided we wanted to have a look at here. So the first question was, does anybody care about this? So I talked to some money managers. I'm on FASAC, and so I get stuck in limos with poor money managers, and I pick their brains about what matters to them. And clearly what came back was that they care a lot about liquidity uncertainty. And the reason for that is because they care about the level of liquidity when they choose to transact. And if liquidity dries up suddenly, and especially at inopportune times, that's a very bad thing. And there's a couple quotes here, but the basic punchline is, as important as the level of liquidity is liquidity's uncertainty. So then the question was, so could we find a theoretical reason to believe that that might be true? And I want to spend a few minutes on this because this is where I learned the most in this process. So the first paper that I found very helpful was Grossman and Miller. And I sometimes think of myself as the goldfish of research in the sense that they say that goldfish never get bored because their memory is about 20 seconds, and so everything looks new and fresh, right? So I think I've probably rediscovered this paper about 3 times. In fact, given it's 1988, I was probably in Merton Miller's class and he covered this paper. But I rediscovered it recently, and the reason I like this paper is because it helps you think about what liquidity is, going back to Scott's earlier point. And in particular, what they argue is that we've typically been trained to think about prices being set simultaneously. And so if I have a block of a mid-sized Turkish manufacturing company, I walk into a room with lots of other people who have a hankering to buy or sell that, and prices are set in an auction. And their point is that in practice, in many markets, prices are set sequentially, in the sense that when I walk into that room to transact, nobody else is in the room, right? Because nobody else woke up that morning wanting to hold that position. And so I value liquidity because, for example, I've had withdrawals from my funds, And so somebody steps into the breach there to take the other side of my position, and those are speculators. And they, of course, take the position because they get a discount. That's what they demand in exchange for taking this position. And then they take on the risk. And so a liquid market is a market in which you can transact without moving price very much. Or put the other way, an illiquid market is a market in which it's very costly to transact because these people are demanding a lot of discount to take the other side of the position. Why is this nice? The reason it's nice is, number one, because I think empirically those kinds of effects are big trading costs. But number two, one of the things I was concerned about going into thinking about liquidity in crises is how you can have an illiquid market with lots of trading, right? And I thought, we're going to have a hard time finding anything here. But of course, liquidity is not volume. So if people are sufficiently desperate, they'll be willing to trade even at very big discounts, but we still think of that as being an illiquid market because it's very costly to trade. And the third thing is just sort of a political statement, which is speculators are our friends, right? Because often we think of speculators as being bad people. In fact, the term is sort of pejorative because we say they have short-term interests, they're exploiting the pain of others, they're disrupting markets, right? But clearly in this kind of a framework, that's not true. They're what make markets run efficiently, and if you tax them or if you regulate them and drive them out of the market, it means that you have flash crashes, right? You don't have anybody to take the other side of the transaction. There's no liquidity. Then we need something that causes liquidity to change, and so that's where Bruno, Myron, and Peterson comes in, because they build on Grossman and Miller, and they say if we want to understand why liquidity moves, we have to understand who these speculators are and how they're financed. And so the speculators are financed with a combination of own capital along with borrowed money. And so that anything that hits as a shock to own capital or borrowed money is going to cause the availability of liquidity to change and therefore its price. And so, for example, if the stock market drops, these people are net long the market, which means that they have very little of their own capital at exactly the same time that banks are disinclined to lend to them to take positions because there's a lot of uncertainty in the market. And so you have liquidity drying up, and you have this tendency then for it to be very expensive to transact. Okay? And what happens in these kind of environments is the stocks about which there's a lot of certainty about intrinsic value, or the assets in general, U.S. Treasuries or whatever, they hold up liquidity quite well, right? The fragility comes from the asset classes about which there's a lot of opacity. And so that's what we're going to be interested in here, is simply asking the following questions. First of all, is it true that liquidity is much more fragile in stocks that are more opaque? Okay? Secondly, and this comes out of Bruno, Myron, and Peterson, this notion of feedback loops, right? So it's not just that liquidity can dry up a little bit, it's that liquidity drying up feeds on itself through price movements, and you can end up with these things called liquidity black holes, so liquidity ceases to exist entirely. And the question is that more common for stocks about which there's more uncertainty about intrinsic value? The third thing is, and this is a big point of Bruno, Myron, and Peterson, that basically what happens is there's these covariance effects that are very important in liquidity, right? So what you get out of that kind of a model is that liquidity moves across all stocks because, for example, when the stock market drops, liquidity in general dries up. And so the question is, is this stock very cyclical with respect to liquidity? And the stocks, again, which are more opaque, are going to tend to be more cyclical in terms of liquidity, which is important because it means liquidity dries up exactly when you value it. Right? So a stock that's opaque is going to end up having very little liquidity at the very time that other stocks don't have any liquidity, and you'd like to be able to get out of positions, and the market is down, and so you have things like redemptions. And then finally, all of this is going to be exacerbated during crisis periods, and the reason for that is because the speculators are net long the market, and so after a month of a big stock price drop, there's no money left in people's pockets, capital is slow moving, and banks are disinclined to lend, and so that's when it's going to be especially important to have transparency. And then finally, investors are going to care about these things through Tobin's Q. So just very briefly, that's the idea, and of course I wouldn't have shown you these hypotheses unless they were supported by the data, so I won't have to spend much time on this, and I'll skip a couple slides in the interest of time here. Let me just say it's an international sample. Why? Because I think crises, liquidity, and transparency are bigger issues internationally, and I like international research in general, but it all works in the US if you prefer to do that. Transparency is a function of the quality of the earnings signal. the kind of auditor, the kind of accounting standards, how many analysts follow the firm, private information acquisition, as well as analyst forecast accuracy. We control for everything, so I'm not going to show you controls, but we do. A level of liquidity being especially important here, right? Because we don't just want to be documenting transparencies associated with the level of liquidity. It's the second and subsequent moments that we care about here. This is the story in one picture, and then I'll just show you a couple tables. Basically, what we've done here, this is residual liquidity uncertainty, residual liquidity volatility. We've split between high and low transparency. Lots of controls in here, including country. So this is within country, within size, within lots of other things. What do you see? You see three things we care about here. First of all, liquidity as uncertainty is in general lower for high transparency stocks relative to low transparency stocks. Secondly, during crisis periods, we see huge increases in liquidity volatility. And thirdly, the gap between these two lines gets much bigger during crisis periods, which just means that transparency matters more to liquidity uncertainty during crisis periods. So here are the results just very briefly. This is just liquidity volatility here as a function of our 5 variables. Each of them loads consistent with the notion that liquidity volatility is very sensitive to the level of transparency. Again, lots of controls here, including the average level of liquidity. Then we aggregate into this transparency variable because we know that these are not independent constructs. The auditor affects the quality of the accounting signal, for example. So moving forward, we're going to use an aggregate measure. But what's interesting, if you put all 5 in there together, I think one of them loses significance, but they're all sort of picking up independent pieces here as well. So the next thing we do is we look at extreme illiquidity events. And I want to emphasize, when I show you these tables, everyone's going to look the same, right? But the underlying dependent variables here are not highly correlated with each other. And in fact, I could throw each dependent variable in as a control in any of these regressions, and each of these effects is incremental. So these are liquidity black holes, which is basically cases in which it becomes prohibitively expensive to get out of a position. Those are much lower for transparent firms. This is just liquidity skewness. How often do we see extreme illiquidity events? Again, highly correlated with transparency here. This is the covariability of firm-level liquidity with market liquidity. So how, systematic is the liquidity volatility? And that's basically much lower for transparent firms, both with respect to the liquidity firm level versus market level liquidity, as well as firm level liquidity versus market returns. So transparent firms' liquidity tends not to dry up at inopportune times, which is, of course, we think a good thing as well. And then finally, this is the crisis analysis here, and I'll just drag you through one column because it holds across all of our variables. And again, I want to emphasize that I could throw the other variables in as controls, and we would end up with exactly the same answer. But let me just give you a couple points to note here. The first one is that transparency is negatively associated with all the measures of liquidity volatility, as we would expect. The second one is this is a market down big indicator. It just says, was there a big stock price drop last month? So is it likely that capital is tight? The answer is liquidity volatility is much higher subsequent to, or any of our measures are much higher. And then the last thing is the interaction with transparency transparency is much more important in crisis periods. And then what we do is we split into large crises and huge crises because there should be a nonlinearity here. And that's what we find. Everything is much bigger in very, very large crises. And again, nice thing about an international sample is we have a lot of crises spread over time around the world here. Finally, the question is, do investors care? I gave you some quotes, but I thought this result was kind of striking here. Notice that this is each of our variables, our dependent variables here, each of our liquidity uncertainty variables. Each one is strongly negatively correlated with Tobin's Q. And most interestingly, when you put them all in together, they remain all significantly negatively correlated with Tobin's Q incrementally, which also tells you that there's not super high correlation among those variables. So that's basically it. We think it's sort of an interesting result that transparency does seem to matter to the uncertainty of liquidity, and investors seem to think the uncertainty of liquidity is important. Thank you.
Thank you, Mark. And for our final speaker, Florin Vasvari, talking about liquidity capital in credit markets.
Thank you.
It's got about 12 minutes.
Just to be a bit more specific, I'll be talking about liquidity in the bond market because there are lots of debt securities here. Just a quick overview of my presentation. I will start by showing you some interesting statistics and graphs on bond trading, which I have compiled recently, and I hope they will be very interesting to you if you're not familiar with the bond trading data. And then I'll be talking about potentially new and interesting measure of bond illiquidity, of bond liquidity, and hopefully if I have time, those last 2 minutes, I'll talk about some potential research questions that one could look at, especially from an accounting perspective. So in terms of data, these are obviously the largest data sets that are available and the only data sets that provide information on bond transactions. The first one is the TRACE system, which is the is the Trading, Reporting, and Compliance engine provided by the National Association of Security Dealers. That provides bond trading data almost in real time. So within 15 minutes of a bond transaction, you'll get that bond price in the system. It's very powerful, and it's free. It's available for free. The full coverage started in 2004. So currently, the data set covers 99% of all bond transactions in the United States. The second data set is provided by the National Association of Insurance Commissioners, and that covers only the bond transactions of insurance companies. And that is useful before 2004, when TRACE had very limited coverage. So in all the graphs that you'll see, I'm basically combining the two data sets, and literally I'm augmenting the TRACE system, the bond transactions in the TRACE system, with emergent transactions from insurance commissioners. And I think this might be the gold standard, and there are some other data sets that are available there, like Bloomberg and DataStream and FactSet, but they typically have this huge problem in the sense that they have these matrix prices. So the data provider computes artificial prices, and the transactions that you see there are not real transactions, are just prices generated by their models. So I think that's the main advantage of using these data sets. So what is happening to bond liquidity over time? And here you have a graph from 2002, the beginning of 2002, when TRACE started. And again, as I said, I combined these data sets. That's why you have a blip at some point in 2004 when TRACE started to cover these bonds better. But over time, apparently, more and more bonds are trading. And what you see here, for each month, you have a dummy variable for a bond that is trading. And all those bonds that are trading in a given month, I divide that by the number of bonds outstanding. Okay? And I do that using the number of bonds, but also the face value. So apparently, it looks like the bond liquidity has been improving. Well, not really liquidity, but at least bond trading, which is quite interesting. But is it really the case? Well, if you look more carefully at the data, if you look at the number of bonds outstanding and the number of bonds trading at during each of these months, apparently the number of bonds that trade is stuck somewhere around 11,000. So 11,000 bonds trade on average every month, almost consistently since 2004. But again, that's the time and TRACE started to cover these things better. And apparently that increase in the bond trading is not really driven by the number of bonds that trade, but by a decrease in the number of bonds outstanding during each of these months. So what is driving this decrease in the number of bonds outstanding? Well, one is definitely the crisis, and this is a graph that is complementing, I guess, Murillo's graphs. You can actually see that towards the end of 2008, especially after the Lehman crisis, there was a significant drop in the number of bond issues. And here on the vertical axis, I have the number of bond issues every month. So there was a significant drop in the number of bond issues, but more interestingly, there is a significant decrease in the maturity, in the average maturity of these bonds. So if you look at the average maturity of these bonds issued from 1990, at that time, bonds were issued with an average maturity of about 25 years. Very recently, the maturity has dropped significantly, and this is quite an interesting empirical fact. Currently, it's somewhere below 5 years. So apparently, the bond market is focused on the very short-term bonds now. So what are the factors that drive trading or liquidity maybe in this market? These are two of the factors. One is the rating category. Obviously, most of the trading is in the A and BBB categories. As the credit quality decreases, you see less and less trading, meaning that the bonds are less likely to trade. Very similar with the bond age. As the bond matures, there is less trading. There is actually a window of typically 5-6 years after the bond is issued, and that's when you see a lot of trading. After that, the bonds get stuck into these buy and hold portfolios, typically of insurance companies that hold about 40% of these bonds, and you never see them trading. So some statistics, and that is probably an interesting table if you compare it with the statistics in the equity market. But on average, a bond trades about 34 days per year. And if you look at the median, it's only 10 days per year. And the turnover is actually quite low. It's 0.23, which is the face value of the bonds that trade divided by the outstanding amount of the bonds that trade. And if you compare that to the equity market, where the turnover ratios are about 20 or 30, this is a significant gap. So 0.23 in the bond market, about 20 or 40 in the equity market, depending on how you compute turnover, if you include the high-frequency trading or not. So the number of transactions per year, only 190 transactions, and I'm here including also the intraday trades. So very few transactions, very difficult to compute any liquidity measures given this data, even though the data is huge. So what is the solution? Well, people in the past looked at bond liquidity indirectly. They were looking at bond characteristics like the bond age or the bond rating, and I just showed you that those variables tend to be associated with the propensity to trade. Another alternative is to look at the bonds that trade and use one of these liquidity measures like Amihud or roll or the zero returns measure and compute the liquidity only for the bonds that trade. But that would mean that you would compute liquidity measures for only a very small subset of bonds that trade, and for the vast majority of bonds, you'll not be able to compute any illiquidity measures. So in this paper that I have with Robert Bushman and Ann Lee from University of North Carolina, we are trying to come up with a new measure to capture this bond liquidity. And the idea here is to look at the, to capture bond illiquidity based on the liquidity preferences of these bond investors. So in this paper, we propose this measure, and I'll quickly explain you how we compute the measure. And at the same time, we also test the validity of this measure. We have lots of tests in the paper. But most importantly, we want to check whether this illiquidity measure that we compute is actually priced. And to do that, we test this Acharian-Peterson model and verify whether there is a premium in the bond spreads associated with these liquidity levels, but also a premium associated with bonds whose liquidity moves with the market. So one major advantage of our measure is that you can compute illiquidity for bonds that don't trade, and you can compute illiquidity measures with a very high frequency. And as I said, we have tested the measure, and it seems to be providing the right results. We use in order to compute this measure, we need a new data set, and we look at a data set provided by Morningstar and another one provided by the National Association of Insurance Commissioners. And these two data sets that we combine tell us every quarter who owns these bonds. Okay, who are the investors in these bonds? And on average, we capture about 40-something% of bond ownership. Okay? So just a quick example on how we would compute this measure, right? So let's suppose we are interested in computing the liquidity of bond number 3, which is not traded. We track this bond, and we find that the bond is in the portfolio of these two investors, investor 1 and investor 2. We look at investor 1 first. The investor has few other bonds in the portfolio, and we only look at Morningstar gave us data on 28,000 mutual funds that have a focus on fixed income investments, so at least 70% of their portfolio is on fixed income. So we compute the liquidity of the bonds that trade based on the typical measures that we have down here. So, and then we aggregate that liquidity at the investor level, at the investor 1 level. We do the same for investor 2 using the liquidity of bonds 4 and 5 that trade and for which we have data. And then we aggregate the liquidity preferences of investor 1 and investor 2 that own bond number 3 based on their relative holdings, right? And we end up with the implied liquidity measure, if you want. And the main assumption that we make here is that investors have liquidity preferences. So if you look at their portfolio, and this is actually supported by theoretical research, at least 2 papers by Amihud and Mendelssohn in 1980 and 1986. If you look at their portfolio, then you'll see bonds that have similar liquidity characteristics, okay? So we compute these implied liquidity measures, and the great thing about these measures is that all of a sudden we can increase the sample size from, if you look at any year here, the top ones will give you the classic liquidity measures. The bottom, you'll have the number of bonds for which we can compute the implied liquidity measures. As you can see, the sample at least doubles. And this is even after requiring a lot of data. So we have a lot of tests that we do in the paper. I'll not go through those tests. I have only 2 minutes left. But how is this liquidity priced in the bond spreads? Well, one way to do this is to first we regress. We have a lot of tables, but here we kind of have some graphs that tell you the economic significance of these illiquidity measures. And to figure out this economic significance, we first run a regression of the illiquidity measure, our implied illiquidity measure, on a lot of factors that potentially drive credit spreads, like credit risks. So we proxy that with the market CDS prices and the recovery rates, the term structure level, the curvature and slope of the yield curve, industry ratings and bond fixed effects. Now, the residual will be something which is orthogonal on all those factors. We run a regression of bond spreads on that residual, and the coefficient in that regression is giving us the price of liquidity, if you want, the sensitivity of bond spreads to illiquidity. And as you can see, we have plotted that we run those regressions cross-sectionally over time, and we plot the coefficient. As you can see, towards the end of 2008, the price of illiquidity has shot up dramatically. And if you want to see the impact on the bond spreads overall, we multiply that price by the difference between the 10th and the top 10th percentile and the bottom 10th percentile of this residual liquidity measure here. And we get the residual liquidity premium in the bond spreads, which is about 8 basis points before the crisis, but then jumps to about 70 basis points during the crisis. We also look at liquidity risks, and that is the covariance between changes in the individual bond liquidity and market liquidity or market returns, as per Acharya's model. And we find that, I'll not get into computational details, but a very similar way of computing this economic magnitude. We find that the liquidity risk seems to be this liquidity betas that we compute seem to be as important as the liquidity level. At least during the crisis, the liquidity, the systematic liquidity risk, the market risk in this graph is jumping to about 50 basis points. So together, at least during the peak of the crisis, which in our sample is the last 2 quarters of 2008, about 120 basis points in the bond spreads could be explained by illiquidity, either illiquidity level or illiquidity risk. Okay? So I guess the next step would be, and this is actually my last comment, the next step would be to investigate what is driving this illiquidity and whether the accounting has a role in mitigating this illiquidity in the bond market. Thank you.
Hey, Florence, thank you very much. Peter and Trevor have graciously extended the session by a little bit, so we have about 20 minutes for questions. I think people are probably suffering from a bit of information overload. It's like you're trying to cram a lot of material and a wide variety of topics into an hour and a bit. So we'll do our best to accommodate questions as they come along. Okay, so we'll open up for questions. Jake?
This is, I guess, more to Charlie, but during the crisis, there was this feeling of segmented crises, which is that there were the large banks and the large corporations that had a credit squeeze. And my neighbors who are small businessmen, their local banks were saying there's no shortage of money, right? But I think the other paper sort of suggested that it was drawing down lines of credit. So I want to know whether the takeaway is that in the big corporations, big bank market, the lines of credit were being drawn down because the firms were entitled to it. The banks were not encouraging it, whereas in the private, in the small market, there actually was plenty of, the banks were encouraging borrowers to take, was it really two segmented markets, or is it just, or not?
Yeah, I'll take a crack and then you do it. I think looking at it as a segmented market is an interesting idea. The bigger firms were encouraged not to touch their lines of credit, not to use it. That would send tremendously negative signal to the markets. Now, the smaller firms were less concerned about any signals. They did draw on their lines. I wouldn't say that the bankers suggested that they should do so, but they did not cut the lines where, previous research we thought, banks will always cut your line if you don't perform, especially in a crisis situation. But what we learned is that they did work as a lifeline. So I never thought in terms of a segmented markets, but there is a lot of reports, as just repeat what I said, that the bigger firms said they were told if you touch this line, then it's going to be the end of your ratings and access to further liquidity.
On the banking side of the cross-sectional variation, I agree with you that initially the small banks were in a relatively favorable position. But once the commercial loan portfolios became a problem in 2008, beginning then and extending into 2009, then that, of course, changed a lot. And small business lending dried up. So it was really a two-stage phenomenon there. That initially, it felt like I was working with a bank that was a startup in 2008, and they thought, well, this is the greatest thing that could have ever happened to us. And they also, by the way, put some money into some bonds initially, thinking, well, we haven't started up yet. And then, of course, the bond markets got hit. And so what was really interesting was it was, different stages where even banks that had been left out of the major problem got hit one way or another. And so I think across the board, by the time you're in late 2008, credit's drying up everywhere.
Thanks for that. Phil Berger?
Thanks, Scott. I think my question's for Mark. It's on the measurement of the transparency or the opaqueness in the cross-country study. So I'm just trying to think about how easy or not easy it is to capture the construct. And if I remember what you were going through, and one of the things was like discretionary smoothness, and one was forecast accuracy. So in a way, I get how those are getting at transparency or opaqueness, but I'm not completely sure that they're the same in each country or that they're even the same construct overall. I guess here's what I'm getting at. So, think of the discretionary smoothness. Is it really right to sort of think that zero discretionary smoothness is the most transparency? Like, there's never a time when it's useful to have some discretionary smoothness in the sense that it sounds kind of like accruals. I mean, maybe that's true and maybe it's not. And then think of it combining with forecast accuracy in the same supposed construct. So firstly, is forecast accuracy even a desirable property in every country, depending on, the main form of financing in that country being whatever, equity-oriented or bank-oriented or whatever it is? Think of, is timely loss recognition going to lead to, more or less accuracy? So that sort of confuses me in terms of each of these individual things, I guess. Is it really the same in every country? But then if you combine them together, I just don't see, like, if smoothness is bad and accuracy is good, And wouldn't smoothness lead to more accuracy? It just kind of is not clear to me how this is all one construct. So you know.
So, I mean, let me start off by saying the paper was 60 pages long, right? So, obviously, I've glossed over lots of stuff. So, just a few points. Number one, all of our analyses are within country, right? So, we're not comparing across countries. So, if things are different in different countries, that wouldn't affect us. In fact, things work in firm-fixed effects, right? So, even within a firm. But then also, we take each of these constructs, we correlate them with, well, so take the smoothing measure, for example. So we say, first of all, let's take out the normal part of smoothness of a firm's, so sort of the business risk piece of smoothness. So this is the piece that's above and beyond that. Then we ask the question, is that correlated with the kinds of things you would expect it to be correlated with if it was earnings management? You know, does the quality of the auditor matter? Does the quality of oversight matter? Do managerial incentives matter to this? And the answer is absolutely. Then we take the measures and we tie them back to things like the adverse information asymmetry component of the bid-ask spread and other measures, market-based measures of transparency, and we show that they all correlate as you would expect with those kinds of measures. And we personally, I mean, this is a taste issue. We like to go with more than one construct just because we think each of the constructs have advantages and disadvantages. But to my mind, I mean, having now run, 60 pages of these analyses, these things, they walk like a duck and they quack like a duck, and I can't guarantee that they're a duck. But we run simultaneous equation systems. I mean, we run selection models on this stuff. So I mean, I share your concern. I think the problem is opacity is a very important construct, and either we say, screw it, there's nothing we can do about it, and by the way, that's why we exist as accountants, right? Or,
No, that was most of that gave me a lot of comfort. The only part I wasn't sure I followed. So, are you saying that you think that forecast accuracy and smoothness are part of the same construct, or they're two separate constructs?
Well, I think there's two components potentially of the same underlying construct, right? So, again, this is sort of the excess smoothness of the system, and so then the question is, is that a piece of what determines whether or not things are forecastable? But I don't want these to be, there's a lot of aspects to transparency, right? And so in one case, transparency is being influenced potentially by the fact that the earnings stream is being abnormally smooth. And in another case, transparency is being affected by the fact that analysts are doing a lot of work. And I think, at least empirically, both of those are good things. But they don't have to be exactly driven by the same underlying construct here. I guess that's your question, yeah. And you're absolutely right. I mean, I want them to be pieces of components of transparency, but they don't have to have the same primitives necessarily.
Thanks for that. So now there's a bit of inter-panel discussion that wants to take place. So Charlie, I think, has a couple of questions for Mark and Florin.
Well, it's really, I wanted to open a dimension of the discussion having to do with the capital market, liquidity issues. In a paper that Inessa Love and Soli Martinez and I did, again, internationally, looking at equity markets, what we found was, looking at returns now as the dependent variable, that what was interesting is that within countries, this is also taking fixed effects across countries, that within countries, the relatively liquid stocks, that is measuring their liquidity prior to the crisis, suffered the largest declines in value during the crisis. The one exception country for that, by the way, was the US. The internal differences in liquidity didn't matter. So I want to raise this because I thought it's a really interesting question. And by the way, I don't think that happened in the debt markets. It's kind of the opposite. There was a flight to quality toward treasuries in the debt markets where you saw pricing effects for the less liquid instruments, the prices go down. But in the equity market, it was the opposite from a pricing standpoint. And it seems to me that that raises an interesting question from the standpoint of evaluating funds during the crisis, that as these markets are drying up for some of these equities, you're actually seeing less price decline, whereas the funds that are more liquid, that are actually not having an invisible loss, it's a very visible loss, are looking better. And I wonder, I just sort of wanted to open that as a topic for how you think about evaluation of funds during a crisis, given that these I think our findings are very complementary with yours, but they're looking at returns, which is giving you this kind of paradoxical effect.
And actually, that's something that Mark and I have talked about, actually looking at it sort of explicitly, because it seems to have something to do with clienteles. And in particular, I mean, a very interesting paper is by Christian Lundblad, and he has data that's fairly disaggregated in terms of short time periods, fund holdings in emerging markets, for example. And so one of the sort of fascinating results he finds, which is intuitive but a little scary, right, is that when there was withdrawal from the funds, these are US funds, right, the countries that got screwed were the liquid ones, right, because you couldn't pull out of illiquid markets.
Right.
And so you paid this penalty. So we could, the reason we thought it was interesting is you could imagine a scenario in which transparency hurts you because it creates liquidity, and when, you know, if you have investors who have to withdraw suddenly.
And this is a story about international sovereign debt markets. For example, Brazil got creamed in its international sovereign debts during the Russian crisis in 1998 and early 1999. Brazilian yields went hugely up because they were the thing you could sell if you were an emerging market hedge fund manager. So it's an interesting paradox, right?
Oh, it is. No, it's very interesting.
Right, so to add to that, but similar to your historical perspective, that's common. Like LTCM had similar issues,
Yeah,
spillovers.
I agree.
Like so the equity sort of quant crisis in August 07, so August 7, 8, 9, you had long-short funds down 30, 40% in a day in response to some multi-strat vehicle delevering in the end of July. So they were selling what they could sell, equities, and you're exposed, you know, ODR. It's a hidden risk that pops up, you know, once in a while.
But if I may add, you're asking about the evaluation of funds. We were actually thinking of a research idea where we could compute, you know, we're thinking to measure the liquidity of their portfolio and see whether that is a good predictor of their future performance, especially in situations of stress like the crisis. Because I guess, you know, a lot of investors just look at performance per se. You know, what is the return that you give me this year? But they don't look at the underlying risk, which is one of them could be this liquidity risk.
Cool. Do you have a question in the back?
It's actually much a comment as anything. I'm on the next panel. I'm David Russo. I'm the Chief Financial Officer of the Institutional Securities Group at Morgan Stanley. So this conversation is very much to the heart of what we witnessed and what we saw. Let me put something out there. I'm a bit less technical, but it's quite possible that what you saw was truly the liquidity drying up in the secured financing market for equities outside of the U.S. And what happened in the U.S. is we had a backstop, a lender of last resort through the Federal Reserve. And so it's fascinating to think about the interplay of how having a liquidity provider during the crisis might have actually affected asset value. And when you didn't have that in Europe and in Asia, you had a very different situation where you saw asset value change even for the most liquid because they actually weren't the most liquid as everyone unwound the secured financing that they had against it. Something to think about.
Interesting.
Charlie, do you have any comments?
No,
on
it's
that?
just, I think that's an interesting observation.
Okay, Shiva?
I have a question for Mark. Mark, in terms of your study, I think the way I understood it was you have a causality statement actually going from opacity causes liquidity uncertainty. First, is that statement correct?
Oh, I don't think I've ever written a paper that has a causality statement in it. I think I've made presentations with causality statements, but if I ever have, I think the word was an association. But anyway.
But at least you were motivating it based on causality.
It was a bait and switch, yeah.
Right. Did you consider the possibility that causality runs the other way as well? In the sense like the liquidity in the market is probably a proxy for, the liquidity uncertainty in the market is a proxy for the uncertainty of external financing that a company can receive. And if my external financing is extremely uncertain, then I won't be able to meet analyst forecasts. What I can do in order to achieve analyst forecast or what I can do to smooth my cash flows is all extremely limited. I'm actually a constrained firm. So in that sense, it might not be the case that it's opacity leading to uncertainty, but rather it might be the other way with external liquidity uncertainty driving or being one of the reasons why the firms are suffering opacity.
I mean, it's possible. We do a few things on that. The first thing is we do propensity matching, right? So we're concerned about what the underlying economics are of these businesses. So we actually go through and do propensity matching just to make sure that they're very similar in terms of underlying business risk, for example, because that, you know, that concern was definitely raised. Also, we take comfort in the fact that it works in things like firm fixed effects, right? So it's not just fundamental differences in the kinds of firms. Also, one of the things that we liked, well, we also always use lags, right? So we try to exploit lags to the extent we can, and lags with firm fixed effects make it more difficult to tell that kind of story. And then the other thing that, no, I'm forgetting the,
I think you need more lags, Mark.
what's that?
I think you need more lags. So we've got a couple of minutes left. Want to get Ted to ask a question?
Yes,
Sorry.
question for Charlie. You emphasized the dimension of risk. I'd like to ask you if you have thought about off-balance sheet risk, especially for banks.
Yes, quite a bit. Now, I didn't get a chance to talk about all the dimensions of my reform program, but I think that there are some very interesting things that will deal with that. But when we want to think about it, we have to be thinking, as always, about incentives, and particularly about incentives to timely replace lost capital. So my view is that the best kind of insurance against those kinds of games is contingent capital instruments with fairly aggressive, that is high, triggers, and that's another topic. In other words, I think we can do a lot better to measure risk, but there are limits to what we can do to measure risk. So I don't share all of Steve's pessimism yesterday about measuring the risk of large banks, including off-balance sheet. But I think that what we really need to do is create incentives for them to timely replace losses, and then we don't worry so much about measuring the risk perfectly. So quick answer, though, is, so I have a new approach to measuring the capital needed for off-balance sheet exposures on securitizations, which I developed for a particular bank. And the approach uses the early amortization triggers, which are extremely important for understanding when capital might really be needed in an off-balance sheet position. For looking at, using Monte Carlo techniques, looking at triggers of early amortization, and then trying to budget capital accordingly. So actually, I think we could, if we really start thinking about how capital absorbing events happen in securitizations, by modeling the triggering events of the securitizations, that's an approach that hasn't really been talked about much. So that's where I'm headed with that topic.
Cool. Great. Thank you, everyone. We've run out of time, so hopefully you enjoyed that session.